Hello, in this segment we're going to talk about contingencies. And you'll remember that a contingency is a liability in waiting, so to speak. We're waiting on some future event or activity to take place to know the exact amount. Examples of contingent liabilities include warranties. So when a company offers a warranty on a product, we know some people are going to bring it back. We just don't know how many or when. Coupons. We flood the market with coupons. We don't know how many are going to be used, so we do our best and estimate it. Lawsuits is another contingent liability. You know you may have a settlement, but you don't know how much it is until the court case is settled. Another one is deferred taxes, and more on that in the next one. So exactly what is a contingency? A contingency says that we need to recognize that this liability may happen in the future, and we're going to do the best we can to estimate what that could be. Now, if it is highly probable in the United States, we make a journal entry for that contingent liability. So at the end of the year, we make a journal entry for warranties, for coupons, for lawsuits if we can estimate what the number is, for deferred taxes. All of those we make journal entries for. But our threshold of when we book it or make a journal entry is much, much higher than it is around the world. So notice it says under IFRS, which is the International Financial Reporting Standards, instead of calling them contingencies, reserves, they call them provisions for contingencies, and their litmus test is more likely than not. So they have a lot more provisions on their financial statements about things that might happen and about how much they are. Here's a chart that explains a little bit about when do we make journal entries and when do we make footnotes. So wherever it says disclose, those are footnotes. Wherever it says accrue, that means we need to make a journal entry. So notice we don't make any journal entries for contingent gains, for good news. We do make journal entries for contingent losses where it's highly probable and we can come up with a reasonable estimate of how much it is. We will book it or make the journal entry. So what does that journal entry look like? Well, for warranties every year, we make an adjusting journal entry, which is debit warranty expense and credit estimated warranty liability or warranty reserve, something like that, which is a liability account. The amount here is an estimate, and that estimate is our best guess, given that we made that sale this year, of how much warranties will take place in the future. When the actual products come back for warranty work, and we know the actual numbers, we're going to debit that liability account, estimated warranty liability, and credit cash or inventory if we replace the goods or repair the goods or whatever. So that's basically how we handle warranties and the entries that are involved.